Okay guys, have you been struggling with ICT strategy? Then watch this video till the end. Then you will thank me later.
Now we reach the next important topic. Which fair value gap to choose? Here these are fair value gap areas marked on the chart. The idea is to wait for the price to enter these zones and look for buying opportunities. However, we are only interested in these two areas. Now, why we are not interested in the first zone? The reason is if we consider here the start and here the end of the latest impulsive move and apply the retracement tool. These two areas are located below the 50% level, which is the discount zone. And this FVG is located above the 50% level, which is the premium side of the range. So, we are only interested in buys in the discount zone due to multiple reasons. Usually, the market loves to take out the early buyers. So, a more conservative way to enter the long trade is to wait for the price to enter the discount. This increases the chance of success and reduces the chance of being the victim of a liquidity grab. Here in the bearish scenario, we have two fair value gap areas. So basically, the idea is to wait for the price to pull back to these zones and enter the short trade. But if we apply the Fibonacci retracement tool, we will notice that this imbalance area is located in the premium, and this one is located in the discount. So as I mentioned earlier, we are only interested in selling in the premium side of the range. So this will be a solid area to look for short setups. This is a more conservative way to enter the trades, which also results in a higher risk to reward ratio. It works best when the market is making deep retracements. But if we are witnessing an aggressive trend, selling on the discount side of the range can also be profitable. However, the important point here is that you're not going to win every single trade, even if you only take high-quality setups. Sometimes the market has different opinions. Even with a 30% win rate, you can be profitable as long as you have a solid risk management plan. You can't control the outcome of a single trade, but you can control the outcome of the overall good risk management plan. As long as you take the high-quality setups and stick to your rules, you will be fine. And actually, you don't need to win every single trade, and that's how you become emotionless to the losses. Now, with all being said, let's continue with the second part of this video, which is a fair value gap trading setup. Now, here on the candlestick chart, we have multiple breaks of structures to the upside, which shows that our direction is bullish. Then the market made a reversal liquidity sweep pattern above the previous high, which signals that a possible reversal is coming. This reversal later is confirmed if we get a break and close below this low. This is called a change of character, which shows that the buyers have failed to push the price higher, and the sellers are now in control. In the bullish scenario, the change of character happens when the price trades below the lowest point for 2 consecutive highs. Then the price is more likely to reverse, especially if it was in a long-term uptrend. Now, remember, if you can't clearly identify the market direction in a specific time frame, it is better to move on to the next pair. Because unclear market direction in a specific time frame increases the risk of making uninformed trading decisions. Moving on to the next pair allows traders to focus on opportunities where the trend is more apparent, promoting better decision-making and risk management. The second thing we look for in the higher time frame is the key levels. We identify the key levels for two primary reasons: identifying the liquidity areas and potential reversal points that are our higher time frame targets. When analyzing the chart, we consider the traditional support and resistance levels as liquidity areas, especially equal highs and lows or multiple rejections, which are considered critical liquidity zones. Now, why do we even need to identify liquidity areas on the chart?
FX, go signing out. Ta-da!